Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our March monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you next month at our quarterly investment forum at Perry's. You should be receiving an invitation about that very soon, where we'll be talking about all of these items in much more detail. So markets presently are backing up a little bit, back from all-time highs at over 6,000, now in the 55 to 5,600 range. We'll unpack some of the reasons why that is in just a second. But before we begin into that, this is just kind of a reminder that pullbacks like these are not unusual. Going back to 1980, the average pullback intra-year is 14%. So it's pretty common to go back to a 10% or more pullback. At present, we're at about a 5% drawdown year to date. That said, we did start 2025 positive in January, and in periods of time where that has happened, that 80% of the time you get a positive year going back 61 years. So overall, that's supportive of the markets throughout the balance of the year. However, we've had a February decline. So if we go through scenarios where there's a positive January and a negative February, this is the average going back almost 100 years of the markets. So, and this is where markets were January and February of this year. So we're starting to see some elevated level of risk, tariffs among them. It's very hard to figure out exactly how tariff policy works and affects both the economy and financial markets this year because they're changing so quickly. But one of the key indicators is tariffs are being talked about, so they're experienced. And on S&P 500 companies, 44% of earnings calls mention tariffs. So it's clearly something that the markets are responding to, and it's an elevated level of risk that will either be short-term or felt longer term. We did get a pretty good jobs report in February, not too hot, not too cold, 151,000 jobs added, and the unemployment rate at 4.1. We also, kind of on a bright spot, got a less hot than expected inflation rate on Wednesday. Consumer prices rose 0.2% in February, and an annualized rate on both CPI and core of 2.8%. So that's, again, heading in the right direction, still not at the Fed's 2% target, but clearly a move in the right direction. And what this can connect to is how likely the Fed is to cut rates in 2025. So the Fed, after raising rates a lot in 2020 and 2023, cut rates in essence 3 times, but a full 100 basis points in 2024. And now we're looking for when and how much the Fed will cut in 2025. A lower inflation rate means the Fed is more likely to continue to cut. So GDP for the first quarter, you're starting to see some predictions of a contraction. Again, we're a long way away from the recession word, which means there's 2 quarters of negative GDP growth. But there are starting to be some predictions, including the Atlanta Fed, that is predicting, for a lot of different reasons, a contraction of the economy in Q1. So as it relates to what are some recession indicators to see where they are, unemployment rate, this has actually changed since this slide is at 4.1 now. Anything above 4.1 is a recession indicator. So you'll see more of these areas are still in the green, which means that they don't point to a recession. A couple like employment, where we're right at that 4.1, and industrial production are showing some signs of weakness. As is the consumer showing some signs of weakness, with debt service ratio picking up. So 11% of household income is spent to service debt, and delinquencies in things like auto and credit cards picking up in the 8 and 8.8% range. Since the consumer drives 70% of the economy, this is something to keep an eye on. So the reason recession or not is important is in large measure, we're in a Fed rate cutting environment. So if we look at 12 months, which again would be September to September, if we, after the first rate cut, if we get no recession, this is what stocks and bonds do. So both very good. If you do get a recession, stocks move to the negative on average and bonds are up. So as it relates to kind of the S&P 500, we continue to talk about kind of a concentration of the top of the S&P 500. So the top 10 companies, so this includes the Mag 7 plus three more, are a full 37% of the weighting of the S&P 500, up from 24% in 2022. And in fact, the Mag 7 accounted for half of the return of the S&P last year at a weighting just in those 7 stocks of 30%. And this is significantly above where we are historically. So on average, we're at about 16% with the top 7. Even in the top, when the dot-com bubble burst, we were only at about 20% of the S&P. So again, we're seeing a very concentrated top of the S&P 500. Now that's been hit recently with the Mag 7 stocks being down, but you're still seeing a very heavy weight in the top 7 to 10 stocks in the S&P 500. We've also, interestingly enough, seen a reversal of sorts where international stocks year to date are doing better than US stocks or bonds or even cash. Debt levels remain a concern. We're currently running budget deficits of 120%. We now spend more on debt service than we do on defense, over $1 trillion. Just some data points of how we got there. 1.8 trillion is the most recent deficit, and that's based on a 4.9 trillion in and a 6.75 out. And again, this just keeps growing, over 1.1 trillion just in debt service, the first time that's ever happened. And what's interestingly, as it relates to debt and deficits, is if we go back to 2019, you'll see that the government was spending 4.4 trillion. So just before COVID, 4.4 trillion. And again, the most recent 12-month revenue is 4.9 trillion. So even inflation adjusted, it's not like a balanced budget of sorts wasn't close. As it relates to outlay versus revenue. Even if we inflation adjust this, we were, if we spent the same amount that we spent back in 2019 pre-COVID, that'd be an inflation adjusted 4.4 trillion against 4.9 trillion in spend. So as it relates to markets and elections, that happened last year, we're only at 10% of the time where on the economy and in the stock market, Republicans are in charge of both the White House, House, and Senate. And of those 10% of the times on the economy, you're averaging 2.8% growth, and the stock market's up on average 13. So again, it's a small sample size because it only happens 10% of the time, but that's the results in the time that this is on both the economy and financial markets. Another interesting sign is just kind of a record high in money market accounts. End of 2024, almost 7 trillion in money market accounts. When this has happened, typically, you see good numbers in stocks over a 3-year period of time, 03 to 06, 9 to 12, and 20 to 23. And just zooming out, talking about markets over now just under 100 years, you still see that markets are positive 73 out of those 99 years, 26 negative. The average up is 21 and a half. The average down is negative 13. And all of these 26 are painful to go through. But this just indicates that both the momentum and the frequency is on the side of up markets versus down. So some revised headwinds and tailwinds. Markets remain, even with the pullback, valuations are pretty expensive. You see a real concentration of the top 7 to 10 stocks. Recession is now being mentioned as a greater probability. An inflation surprise. Tariffs bring about kind of a negative because of their uncertainty. Higher interest rates. The Fed cuts less than expected. Geopolitical risk, debt levels in the US remain high, and earnings disappoint. So all of these things and more are things that are kind of affecting the economy and financial markets negatively. On the tailwind side, the Fed has started cutting rates. That's generally supportive of financial markets. That we do get some widening out of performance, not just within the US, but perhaps internationally. We get a surprise like on Wednesday where inflation actually moved in the right direction, now sub 3%. Tariffs and uncertainty, we kind of list these in both headwind and tailwind. While they're performing more like a headwind today, either their certainty or their removal could be positive. Geopolitical could also move in a positive direction. Transformative AI, Stargate being a public-private partnership to build out power storage, and earnings could continue to be supportive. So all of these things are things that we're carefully following and will be factored into an upcoming rebalance. You'll get trade notes from us very soon. We'll be rebalancing our targeted allocations to adjust for the things that are going on in markets. So again, we hope to see many of you next month at our quarterly investment forum. Look for that invitation very soon. None of this is a substitute for contacting us directly. So if we can serve you in any way, please let us know how any of these things, ask us questions about how any of these things apply to you specifically. So with that, we'll close. Again, thank you for the trust and confidence that you place in us. Reach out to us if we can help in any way. Until we see you again, be well and take care.